So welcome along, everybody. And we'll start with the Karakia Tīmatanga. Does anybody feel like?
I will do it for you, Stu.
Thank you.
Mai te pai maungararo ki te tai, mai te awa tonga raro ki te awa raki. Tēnei te pori awhai ai o taratahi, whanau, hare mai te toki, humie, huie, tai kie.
Apologies. Robin, Marty's not coming. Is that right?
Mm-hmm.
Yeah, well. So we'll record him as an apology. The people who might come. And Ron, Mark.
Well, Marty was a co-opted member of this, so he should be on the front page.
Yes, he should.
Yeah.
Robin and I were talking about that earlier, so we'll have to tidy that up. Conflicts of interest declarations. Oh, can we move the apologies? Please. Yeah, secondly. Thank you. In favour? Aye.
Get some training wheels, shall I?
Yeah, got it. Conflicts of interest declaration. Did that. Public forum. There's not. Confirmation of minutes of the investment committee on the 21st of February. Short and to the point, but there's someone who would like to move in. Second. I'll second that. All in favour?
I wasn't on that committee at that point.
Okay.
It's only then, Steve.
All right. We can argue about that later. Investment update report.
So I'm happy to talk through the investment report, which is the pack, and I will defer to experts online to talk about our investments specifically with Castle Rock Harbour and on our Five Oceans and Milford. I'll let Jonathan and Peter talk to those, but if there are any questions on the report on our current holdings and our investments, I'm happy to take.
Noting that these are to the end of.
Yes, it was delayed meeting, so it was to the end of March. So the one piece that is worthy of note is the on-call and up to 30 days and 31 to 90 days. We did have some cash that we were planning on putting on much longer term deposit, and as fortune would have it, we couldn't. And that cash is most likely to be used to balance the fact that we haven't done the first rate instalment under the LTP. And so we will use that cash instead of borrowing further over the next 2 or 3 month period. So that was rather fortuitous, though not particularly well planned.
I do have a question for you. We've had some discussion about WBS as a possible receptacle recipient of some of our funds. Do we get anywhere with that?
Yeah, so the SIPO that we have identifies potential counterparties through credit rating or credit default risk, and using their Standard & Poor's or in some cases Fitch ratings. WBS doesn't have an investment grade rating, and as a result that means they're outside of our policy.
Yeah.
Sorry.
So perhaps we can ask our friends at Ericsson to tell us.
Yes, so we could hand over to Peter and Jonathan, or knowing the two of them, more likely Jonathan and Peter. But
no, it's too well, Jeff.
I am quite conscious the report that we have in front of us was March, and quite a lot has happened since March, including yesterday. So I will leave the floor to you and to the investment committee to ask questions.
Well, go on, Peter. You have to prove Jeff wrong, don't you?
Oh, I'd love to, Jonathan. I really would. So why don't we? So afternoon, everybody. So if we have a look at the report that we've got in front of us, a March quarter certainly a lot nicer to talk about than more recent events. We have issued the June report as well, so we know exactly how the position or the portfolio is positioned over that time and what the fund managers have done. Now, essentially, you can see within the report. Oh, thank you. My wife just delivered a cup of tea to me. That's lovely. So on page 20 of the pack is the summary table of returns and fund managers. So I'll just walk through those a little. And certainly March was a time period when markets were taking off both domestically, Aussie and global. So some strong returns coming through there and beating benchmarks as well. Since then, up to the end of June, we've probably seen we did see the portfolio detract a little, only 0.1%, largely on the back of some give back from the domestic equity market, Aussie equity market, and also some currency, not the Kiwi Aussie, but certainly against the other currencies. We have a little bit of an event happening over that time period as well, with Castle Point being sold to Perpetual Guardian. And now the thing with fund managers is that being bought and sold in the Kiwi market, or any market really, is not unusual in funds management land. What we look for is essentially what we know about the purchasing party, the confidence that we have in their staff, and in terms of what changes they're looking at making to the overall portfolio. The Chief Investment Officer over at Perpetual Guardian, Tim Chesterfield, we have known for many years, rate him highly. We've had conversations, you've just had one recently, Jonathan, about the Castle Point Five Oceans Fund, and at the moment we are actually viewing this quite positively in terms of the change, both for the portfolio and for many of the staff as well. So no change recommended on the Castle Point Five Oceans Fund at this point in time. Another change over that time period was Milford's co-portfolio manager, Dan Simmons, stepped down and replaced by Anthony Ip. Again, really good management of succession planning within Milford. And Paul Morris continues to be the other co-portfolio manager and the senior portfolio manager. So that's good. In terms of Harbour and Milford, both of those portfolios have produced really good returns over the last 12 months. You've only been invested for 11 months for Milford, but still chiming in well. The one, I guess, that has been a disappointment over this time has been Castle Rock. And even though the fund now has a 12% distribution yield, the fact that the team had written down the share price has actually resulted in the negative returns that you're seeing, and that continued over the June quarter, as well as conditions got pretty tough for some of the underlying companies. And again, we've been in there having a chat to them about their valuation policies and so on. And one of the reasons why the distribution yield has gone up to 12% is because the price has gone down. So it's a little bit of a give and take. But what's happening with distributions is we are reinvesting them, or rather Castle Rock is on your behalf. So that actually cushions the blow in terms of the capital downgrades, in terms of the quality of the income coming through still in that portfolio. I mean, essentially what it means is if the share price stays still at a 12% return as it stands now, but we do expect that income to start tapering off because they are factoring in softer conditions for the underlying holdings. In terms of asset allocation on page 22, everything's nicely in balance still. Overall portfolio was sitting at around 5.2 million at the end of March. At the end of June, let's have a look. That's yeah, it's just a little bit higher, but still 5.2. In terms of what's been happening in the markets, and it's interesting because if you are picking up the headlines, there's a lot of volatility, a lot of fear, essentially coming from a pretty poor jobs report from the US with non-farm payrolls, and particularly against what the expectation of the market was, hammered the US, even more so Japan. But then again, you take into account what's happened with the yen, which has fallen peak to trough is almost 12%. So if you're an unhedged investor, that actually cushions the blow for you. Another thing to realise too is that when you read the market's down 10% and up 10%, that doesn't mean zero. So if you think about it, if you start with 100 and it falls 10%, you're down to 90. If it goes up 10%, you're back to 99. You still haven't got to where you are. So a little quirk of the mathematics there, but it is something to have a think about when reading these volatile statements about what's happening in the market. However, looking through, I mean, the portfolios are doing what they should. The portfolios were defensively positioned in terms of, in particular, Harbour and Milford, which would have done well in terms of capital preservation over that time period. Happy to take questions on the managers or the portfolio before I open it up to Jonathan on his love of the markets.
So can you talk to us briefly about the valuation policy at Castle Rock in terms of
it's very, very interesting because we've actually had 2 discussions with Castle Rock since the write-down. And I don't know if any of you had the chance to join them on the investor webinar where they talked about the performance. They didn't actually address the write-downs because that is a valuation issue. And effectively, the way they value each business is based on either averaging the last 2 years and one forward or the last 1 year and one forward. And because they're conservative, they're assuming that the performance going forward will be less than the performance to date. And in that sense, you're getting a double whammy of negatives from the one negative year that they've had since the interest rates in New Zealand went up. And we pointed that out to them. I was actually a little rude. I suggested to the chairman of the board that their governance of their product was inappropriate. And it was interesting because they actually agreed with us and they're looking to review it. Now, the problem we have, of course, is that we don't know what that review's going to change, although they did sort of suggest one way of looking at it, which is very positive from our point of view. But until they actually do something, it doesn't help investors know what's going to come down the track, except for the fact that they reiterated, and this is the key point, they reiterated that every cent that is distributed to investors, in other words, that the 12% yield that Peter mentioned, that's all coming out of real earnings, real cash flow that those businesses have generated. So, and in that sense, if the position of the New Zealand economy doesn't worsen, then that 12% return is basically still there going forward. And eventually the capital value will go up because it'll actually make progress from there. So I have to apologise because we recommended this product and Peter and I have done extensive due diligence on it, but we didn't expect the board of trustees or board of that company, two of whom I know personally, and we have regular meetings with about investment matters, would actually overlook an issue as significant as that write-down, and the fact that they've had 3 write-downs in a row. They did have a write-down 5 years ago, but since then they hadn't, and they hadn't for some years before we recommended the product to you. And in that sense, it's not the same as a listed market type product, which I'm happy to talk about at length if you want to, once we address the product issues. But in that sense, this isn't a product that should change the valuations nearly as much as it has since you invested. We've got other clients in exactly the same position. But in that sense, we're trusting that they will actually address the issue, and that the next quarterly report, as at the 30th of September, will look a little bit better than the current one.
Jonathan, it's Jeff here. Did they give you a timeline at all as to when they might be considering this review?
Yeah, they said they'd do it this quarter, Jeff.
Right.
Okay.
So just to clarify, sorry, we're looking at a valuation at the end of March for Castle Rock of 945,000. Is it less than that now?
That's my question.
Yeah, it is. So hang on, I'll get the figure for. So the valuation that there's March, go to June. So 926, 661 was the value as at the end of June. So it's about a 5% write down for June with a 3% income return. So down around about 2%.
You said, Jonathan, you know 2 of the directors personally and you have regular meetings and so forth. What's your level of confidence or comfort that they are capable of or seriously intending to reverse the fortunes of their organisations? Well,
Their organisations are fine. It's the product that their organisations are managing which hasn't been managed properly. So there's basically 3 levels of governance, but effectively only 2. They don't have an external investment committee, but the board does have a number of investment professionals on it, including the 2 that I've mentioned. And I have complete confidence in the team they've put in underneath. The 3 new portfolio managers are working well and making good decisions and managing the businesses as well as they can, given the market and the state of the New Zealand economy. As I say, I actually have got confidence in the 2 individuals I've named. And when they say they're going to fix it this quarter, I believe them at this point.
thank you.
Yeah, just to reiterate too that it's not a statement about the quality of the underlying assets. This is a valuation policy issue for the product.
Yeah. When you say the product versus the organisation or the structure, when you say product, what is that? You mean that's the share offering?
That's the collection of the 5 businesses that they are managing and have a large shareholding in, and the way those businesses operate and how profitable they are.
That's like Animates and those ones.
Yeah. So Brooklyn, who distributes
Yeah.
Animates. And part of the problem is that with the recession, Animates has been hit hard because people can't afford to look after their pets the way they used to, by buying them all the luxury pet food or dog food or gizmos that they want to entertain their pets with. They're having to cut back. And so Animates has cut back. And Animats has cut back drastically the number of SKUs, in other words, the number of products they put on their shelves, which has affected Brooklands. But on the other hand, the new CEO of Brooklands is a vet, and he's looking at developing new channels of distribution, not just to Animats and other suppliers like that, but through the Veterinary Association and all the veterinary firms in the country. So that, as I say, it's a work in progress, but that particular one was hit hard by the instant recession we've had this year.
So is this really an example of too many eggs in a very small basket, like a fairly niche, because most of their products are connected to that animal pet welfare?
Yes, so that's that one business. But each business is different, and they've actually, the latest acquisition is an experienced tourism business, an impact investment, which takes students from overseas to go and study and work as a sort of volunteer service abroad role around the world. And that has a lot of income outside New Zealand. But for example, Hill's Pizza is a little bit upmarket in terms of pizzas compared with Pizza Hut and KFC. And so that's been hit a little bit harder than restaurant brands for that. The horse racing industry, which is Majestic Horse Floats, they've got the largest share of that market in the country. But again, the racing industry suffered because people haven't got as much disposable cash. Now Vivo, the hair salons, is actually doing better. They're increasing the number of hairdressers and salons, and they've got a training system. And so that particular business has actually picked up, but that's the only one that has, because the other one is the tile depot. And again, that's starting to come back now, but the construction industry has been depressed partly. And I mean, Fletcher Building's share price has gone down a lot more than Castle Rock's. But in that sense, it is another industry that has suffered to date. But again, given where the New Zealand economy is at, we're seeing a few green shoots in that. And I think the politicians are perhaps learning their lesson of not to act so quickly. I know this doesn't happen at local government level, but I was actually shocked personally to see how fast the new government wanted to change the country. And I think they were they forgot that it takes time to turn an ocean liner around.
Yeah, I guess from a practical perspective, in terms of what our investment committee does, we've got a choice. We could say, let's bail out of this one, or let's stick with it. And my personal opinion, if it was my money, I would say this was the worst possible time to get out.
And given that there's now a stated commitment to address the issues in this quarter, logic would say you'd ride out the quarter and see if they're as good as their word.
Yeah. Is that kind of how you guys said?
Yeah, no, exactly. Now is not the time to pull out. I mean, this portfolio is actually one of the most resilient we've got. The markets have been absolutely brutal. And in fact, both Castle Point and Castle Rock have struggled more than normal. But again, Castle Point is in much better shape now than it was when you invested in it, quite frankly, with the change of ownership and the new direction that it's going in. And in that sense, the three income funds that you have, Castle Point, Harbour and Milford, are our best three income funds. And then Castle Rock is absolutely infuriating because it is actually a very rare private equity product in the sense that it's open-ended. And in that sense, yes, you can get out with quarterly liquidity. So you couldn't get out until the 1st of October anyway. But in that sense, you should definitely wait till then. And by then, I think things will have changed somewhat in terms of the valuation methodology. And I think if you wait till the 31st of March next year, you'll be pleasantly surprised at where the performance of that product gets to. But it is one of these things where whilst your timing of not reinvesting your term deposit was brilliant, the timing of going into these products wasn't as good as we would have hoped. But as Peter Verhart will tell you, you can't time markets. And in that sense,
so true, Jonathan.
Yeah, in that sense, whilst you can't time markets, going into this type of managed fund investment at a time when interest rates around the world are starting to fall, and the market's actually expecting the interest rates to fall quicker than the central banks are willing to reduce them, and that's creating real strains. And of course, in Japan, the opposite happened. That's one of the few countries that's still tightening. Another one is Turkey, but I don't recommend you travel to Turkey right now for geopolitical reasons. But in that sense, it was the Japanese central bank, the Bank of Japan, which caused the very rapid drawdown in markets late last week and early this week our time. Some of that has bounced back, but as Peter says, the markets are still down as a result, and we still expect them to keep going down from here globally. But in that sense, we think that New Zealand, because spring's here and it's a lovely sunny day in Auckland, and it looks pretty good in Carterton as well, we can say that we think the New Zealand economy is actually past the worst, regardless of what the Reserve Bank of New Zealand does next week. But we'll have to wait and see on that, because in Australia yesterday, they held their cash rate, and they actually talk more about putting interest rates up further rather than reducing them. And that's simply because the risks that we're all experiencing, and which Castle Rock's experienced, because all its assets till the end of June were domestic assets, what's happening globally is far worse than the economic pressures that we and Australia are under. China is really struggling to keep its economy afloat. The US economy is still going very well, but when you get a slightly below average level of new jobs being created, the market panicked anyway and sold off because of all the traders around the carry trade in Japan, where people have been borrowing the Japanese yen at low interest rates and buying assets in the US where they're much higher interest rates and they think they can make higher returns. Now, the interesting thing is that the Japanese central bank only increased its cash rate by up to 15 basis points, 0.15%, which, in New Zealand, people wouldn't even blink. They'd say, what was that? I missed it. But that caused this global sell-off of shares, which is now starting to reverse. And there's also that pushed interest rates on longer-term bonds down, and that also is starting to reverse. So I think the moral of this story is to think exactly the way you were thinking about the investment committee. You don't realise you or crystallise your losses unless you need the money desperately for something else. And it's a question of hanging on for the 3-year duration that is what we say these products have on the tin to generate the returns we expect. And I think by the end of 3 years, you should be in much better shape than we were at the end of June. But I also think that with Castle Rock coming to the party, you'll find the performance to the end of September better, and the performance to the end of the calendar year better still. So I think the only issue is what the ratepayers say.
Yeah, I'll just throw in also for the, because you don't have this in front of you, for the June report, the year to 30 June was positive for Castle Rock, only up 0.2%, but it's just shows that distribution yield was countering the share price drop over that time period, and the New Zealand listed share market was down around 1% over the same 12-month period. So just reflecting what's going on in our domestic economy.
Sounds like the share market similar to the weather. You said it looked pretty good down here, and it is right now, but it was -3 at 7 o'clock this morning.
Ouch. It was 6 in Auckland and I felt freezing. Have you got any snow then?
Yes.
On the hills, yeah. And on my front windscreen this morning. I couldn't have a shower
This was pretty good.
pipes were frozen.
Yep.
Kia ora, Peter, Jonathan, Jeff again. So we've seen, I guess there's been a lot of talk about the interest rate yield curve slowly beginning to turn, and economies and potentially in central banks starting to lower official cash rates, which would mean that, you know, this cycle might have peaked, and potentially we're starting to see a change in that. And I guess my question to you is, so we've got a bunch of Milford Diversified Income Fund, and now you've seen, now we're starting to see potential for that cycle to have peaked. Is now a good time to reconsider, should we be in an income fund, or should we, you know, as interest rates drop, should we be in bonds, or, you know, is there another product that you see when we're in this stage of the cycle that may not have been a product we would have considered at the earlier part of this interest rate cycle?
Yeah, that's a very good question, Jeff. So the first point is that, yes, some central banks have started to reduce the cash rate, and others are talking about reducing the cash rate. The yield curve is still negative. It actually turned positive briefly in the States the day before yesterday. But effectively, in that sense, the yield curve is either inverse, where people are expecting recessions, or it's flat. And at some point, people are going to demand to be compensated for locking their money away for longer, and you're going to get higher rates of return at the long end of the curve. So there is a risk that although cash rates are coming down, longer term interest rates go up a little bit higher. That said, as we've just seen this week, equities are incredibly volatile, and we think they're going to get more volatile. So in that sense, too, we like bonds more than cash, and income funds is definitely the right place for you to be, as opposed to growthier products. Down the track, we do have a range of good private equity products available. And I'm thinking in particular of Continuity Capital number 8, which has just launched. Now, that's a fund of funds of private equity, which is like Castle Rock, but the opposite. This is the traditional private equity where they buy into businesses, make those businesses more efficient, and then grow them, and then don't just pay the earnings out, but they actually then sell the businesses and get a big profit, which they pay out to investors. So it's a series of fixed term, usually about a 10-year life for a product. And Continuity Capital is a manager of managers, and so they have a whole range of these, and that is something that, yes, we'd be looking to recommend when we're a bit more confident that the markets have actually stabilized somewhat. And I'm not sure when that's going to happen, because the geopolitics is getting absolutely brutal. I'm not talking about the US presidential election. I'm talking more about the war in the Middle East and the war in Ukraine, and then the social unrest in the UK and in Bangladesh and other countries. There's a lot of strange things happening around the world, which must at some point have an impact, a bigger impact on the financial markets. And so from that point of view, even though at the moment the price of oil has come down, we're not sure whether the supply chains are going to hold going forward, or whether the Houthis are going to effectively block the Red Sea exit from the Suez Canal and other things that could happen. And so, as I say, in terms of the markets, you're absolutely well positioned in our view right now. We would be recommending in the next quarterly report some investment, I think, in something like Continuity Capital or another private equity product, or a product that's not related to the listed markets, because that's where the maximum impact from interest rate changes is going to be felt. And so we want to try and avoid those if they keep going the way they have so far this year and last year. But as I say, I mean, you could always put some more money into these 4 products. I wouldn't put any more money into Castle Rock right now, even though it's a very good buying opportunity. But the point is that again, you only get quarterly liquidity, so you can't actually invest in that until the 1st of October or the 30th of September. And I think I'd rather wait and see whether the 2 gentlemen who I believe are going to do what they said they're going to do, but I want to see the ink dry before I'd recommend it to you again. But apart from that, as I say, I think you're better off keeping cash on term deposit, and definitely paying down debt is always a good thing rather than worrying about reinvestment, although in that sense, obviously the time horizon for your rates and that sort of thing is very different. I just want to add one more point, and that is that there's another regional council that we advise who have adopted the strategy that you're using for some years, and they were absolutely thrilled at the returns to the 30th of June. And they have Castle Rock in their portfolio as well. In fact, they have some other products as well, but they have all the products that you've got in their portfolio. And they're very pleased at the long-term performance of that part of their balance sheet, as opposed to the rates and the infrastructure and other stuff that they obviously have on their books as well.
For a human, you're sounding an awful lot like an algorithm, Jonathan, because you're feeding back to me things that I already know. So for disclosure, as part of my former role as chair of Mangaharuru Tagatu, we had Continuity Capital 3, I think it was, wasn't it, Jonathan? In that investment portfolio.
No, it was two, Jeff.
It was two. It's two.
And since then, I think they've gone into 7 as well.
Yeah, potentially. So I seem to recall when I left, the yield on that investment was running at about 18% return on Continuity Capital 2. So the question we may have to deal with is that could well be an Australian dollar investment denominated. It's not. It's a New Zealand dollar one.
Yes.
Number.
No. The even numbered ones. So continuity number 8 is a New Zealand dollar denominated investment.
Oh, okay.
We wouldn't recommend for you an Australian dollar private equity, although if because I can tease you in your past role, MLC4, which is an Australian private equity fund of global co-investments in the best private equity managers in the world, is going to be open shortly. But because that's in $, you don't want that extra volatility of the Kiwi Australian exchange rate affecting your returns for your ratepayers either.
Yeah.
I guess from our perspective, we have to figure out if we've actually got any money.
Yeah, and also from the investment committee's perspective, a investment like continuity will be less liquid than the investments that we have at the moment. So you would want to ensure that it was only a smaller proportion of your portfolio that you were tying up for a longer period of time and keeping a larger proportion of the portfolio liquid.
And we're so new into this. I feel we're still walking. We haven't got to jogging or running yet.
Yep.
We've got to be careful that we don't get
Too
ahead of
fast.
Yeah.
Yeah, absolutely.
Anybody have anything else for our guests?
Yes. Thank you, Peter. Thank you, Jonathan. We're always appreciative of your time.
and expertise. Thank you.
Kia ora, thank you.
Yeah, thanks, all. Great to see you.
Yeah. So we, unless I'm forgetting something that I have done at odd times in my life, have one recommendation. The committee receives the report. What do you want? I'm happy to move that. Do we have a second? We have a second. All in favour?
Oh, I'm not allowed to say.
I know.
It's only you three.
I'm waiting for you to remind me what else we need to do. I think that's it, isn't it?
I think that's it.
Karakia.
Would you, unless of course you want to pass a resolution or a recommendation up to council for the chair? I don't know. Do you want to?
Well, it would seem to me that would be a good thing to do, and also that we acknowledge that we've co-opted Marty Sabaya, because I think he thinks we haven't actually officially done that really.
I think he needs. Is he co-opted or is he appointed by council?
No, he made it clear that he wouldn't be representing the marae.
Oh.
He was co-opted on because he was ex-finance officer at council, and so in terms of his finance ability, not to do with iwi.
Oh. In which case,
in the absence of an independent chair, which we couldn't find, he was kind of considered to be a halfway house, a little bit of independence, but also some local knowledge and finance knowledge.
so should that be one recommendation?
Well, you could, it'd probably be two, wouldn't it? Certainly one for the chair and one to co-opt Marty Spire.
One, that you formally co-opt Marty Sabaya, the investment committee, and two, that you recommend XYZ be the chair of the investment committee.
So we need to move and second that sort of thing.
I would have thought so.
Someone like to move it.
You could probably move that you, well, it's Marty Sabaya, but no, I don't.
I mean, as chair, as I was the chair, supposedly, me stepping aside as chair brings you directly into the role anyway, because you're deputy chair. Or
No, actually, that's not true. There was no deputy chair position ever, because we had an independent chair, and then
That's right.
and then the chair.
actually the actual deputy, but he actually acted as chair anyway.
Right. So now we're not having we don't have an independent chair anyway.
No.
Just make two motions.
So the position is the position actually chair then?
Yes.
Yeah.
There needs to be a chair of a committee.
And a deputy.
There's only three of you, so
I move that Steve and Steve are the chair and deputy.
We have a second for that.
Hang on a moment.
Can I move that?
Yeah.
Perhaps you could put a surname next to each of the Steves, just for clarity.
Steve Lawrence is chair and Steve Creighton is deputy.
At least now we've got clarity.
Well, you're as compromised as me, but yeah, okay. Yeah.
I
All
can
those in
move in
favour?
second if you want me to.
All those in favour, okay. That's cool. And I'd like to move that Marty Sabaya be co-opted to the investment committee. We have a second for that? Yep. And those are
Second.
recommendations, yeah.
In favour?
Yep.
And those are recommendations to council.
I think that could be I don't think you need to recommend to council that Marty's co-opted. I would need to double check the terms of reference whether you can co-opt. But let's make them a recommendation.
Yeah.
If the terms of reference allows you to make that appointment yourself, we'll switch it to a motion.
Yeah.
You okay with that? Okay.
I'm just looking at the terms of reference.
May not say that. It might have just been the water race one that talks about co-opting.
To be advised.
Okay. Yep, let's make it a recommendation. Okay. Thank you.